Welcome to Dig Deep, the mining podcast. In this podcast, we go deep into mining news, hot topics, and live interviews with mining professionals and leading figures in the mining industry. Introducing your host, Rob Tyson, founder and director of Mining International and Mining International Executive, a leading global mining recruitment and headhunting agency.
Hi, mining community. Welcome back to another episode of the Dig Deep, the mining podcast. And we welcome back a returning guest who I think he's been on, this is his sixth time. And I think he last appeared at the end of 2022. So a regular guest on the show. It's Krishan Gopaul, who's the senior analyst at the World Gold Council. And he's here to discuss what's happened with gold demand trends in quarter two and obviously beginning part of the year, and possibly what's happening for the remainder of the year and the gold market outlook. So that's welcome Krishan to the podcast. How you doing, Krishan?
Oh, well, Rob, thank you. Good to speak to you again.
Yeah, certainly. As I mentioned, you've been on six times now. So those that hadn't listened to previous episodes, I just wondered if you can just give us a quick summary of yourself and obviously what the Gold Council does.
Yeah, absolutely. So as you mentioned, I'm a senior analyst here at the World Gold Council, working in the research team. And the World Gold Council is a kind of an association of members of gold mining companies. And we look to kind of provide education on gold, its merits as an investment, but generally looking to develop the market in any way that we feel is appropriate. So we're very much what we feel our authority on gold in terms of insight. And we look to share as much of that insight and data as we can do with some of our research, with our online properties such as goldhub.com. And certainly on conversations like this, it's certainly useful to help get the message out about gold.
Certainly. You recently published the latest gold demand trends report for quarter two of this year. Just wondering if you just give us an overview of obviously the gold market over the last quarter.
Yeah, sure. So Gold Demand Trends is our flagship report. It comes out quarterly, and as you rightly says, gives an overview of the demand and supply dynamics that we've seen. And the most recent report, which focuses on Q2, we saw that actual global gold demand declined 2% year on year to 921 tons. Now, the reasons for that are mixed. Gold is a very unique market in terms of the sectors that exist within it and how they behave depending on market conditions. So what we really saw in Q2 was gold was benefited from central bank buying, which remains robust. And in fact, if you look at H1 as a whole for 2023, it's a record first half. But not only was it central banks, we also saw it supported by healthy investment markets, particularly in China and Turkey, and also resilient jewellery demand. So even in the face of higher gold prices. So there are a couple of dynamics there that really we can delve into to help explain why gold behaved the way it did over Q2.
You mentioned obviously gold supply in the industry, and mine production reaching 921 tons in quarter two, which amounts to a record mine production of 1,781 tons. What would you say is behind that trend, and how have things moved on from 2022?
Yeah, it's a good question. So you're absolutely right. So Q2, we actually saw record gold mine production for that quarter, narrowly beating, I think it's Q2 in 2018. And when you do add that up with the Q1 2023 total itself, a record for Q1, we get the full half year record mine production that you mentioned. Now, in Q2 specifically, the reasons that we saw for the increase in mine production were twofold, really. So the first was seasonality. So in Q1, and generally this happens at the start of every year, we come out of the winter, and then for those jurisdictions which are more severely impacted by the colder weather, they obviously see their mine production drop But as we move into Q2, you tend to see that pick up. And again, that's a seasonal trend that we see most years. So that's certainly one reason why we're starting to see a pick up again in mine production on a quarterly basis. The other one is down to a ramp up of production, or I should say projects in certain jurisdictions. So for example, we saw a ramp up in some of the projects that are taking place in Ghana. So Bibiani and Obuasi were two that were picking up their production levels. And similarly, I think we saw in Russia too. The other thing I would mention related to that is actually many mines, or a number of mines, say for example in South Africa, which are now back up to operating at full capacity, haven't been impacted by things like production strikes that have been going on in the last couple of quarters or year or so. The one thing that's also worth noting, as you asked about the change to 2022, was very much COVID. Now, it's not something that we mention heavily in the report, and that really talks to the point that actually the impact of COVID on gold mine production has now pretty much worked its way out of the data. Certainly, we saw far fewer disruptions so far this year related to COVID, and none more so was that relevant than in China. So China reported, I believe, a year-on-year increase. And if you look back to where we were in 2022, China was still going through a number of COVID-related lockdowns because of an increase in infections. Move forward to this year, in comparison, there were none. So certainly removing that factor from the picture certainly means that it helps to boost overall mine production when so many of the projects around the world are able to operate at close or at full capacity.
Looking ahead, do you expect production to remain quite high for the rest of the year? And do you see particular countries, I suppose, increasing their production maybe from last year? Any countries or jurisdictions?
Yeah, it's a good question. I think based on the data that we have available currently, I think we're forecasting or are optimistic that potentially 2023 might be an annual record for mine production, given what we've seen so far in H1. However, there are always caveats with any sort of outlook or forecast. So we need to be aware that there could be unforeseen stoppages potentially, or events an impact on mine production, but again, being unforeseen, it's very hard to predict. And then we should also be mindful of gold mining costs. So all-in sustaining costs have actually been rising. I think Q1 2023 saw a record quarterly average all-in sustaining cost. So the inflation picture or story is certainly impacting mine production. So that's always a factor to bear in mind. But nonetheless, as I said, we remain optimistic on mine production for the full year, and certainly we feel that it could get close, if not beat the previous record. And in terms of countries, certainly as a couple I've mentioned, so Russia, where we've seen some pickup in the pipeline, and Ghana especially, where we've seen, as I said, Bibiani and Obuasi really ramp up. They're some of the countries that are worth keeping an eye on in terms of production and the contribution that they'll make to overall annual production this year.
You mentioned obviously all-in sustaining costs as the average has increased. Do you know what figure it's increased from to what it is now?
Yeah, absolutely. So we published a blog on our website. I mentioned it earlier, goldhub.com, and we cover it quarterly. So we provide the data as well as provide the overall number. So all-in sustaining costs in Q1, it's always lagged by about a quarter purely because of the data availability. But in Q1, we saw it increase about 6% quarter on quarter, and that was to around 1,358 ounces. So it's a much higher level than it has been. Again, inflation in terms of things like input costs are certainly a big driver of that. The war in the Ukraine unfortunately led to obviously a big pickup in some inputs like oil and energy, which again fed through into higher costs for miners. So we're certainly seeing margins being reduced, but obviously the average gold price that we're seeing at the moment, again, for the quarter, I think was particularly high. So it's certainly an interesting dynamic that we're seeing at the moment, and one that we'll be watching play out for the rest of the year.
Looking at the demand side of things, obviously central banks, central bank demands obviously continues to remain high, through not at obviously record levels seen in the second half of last year. I just wondering if you just tell us a little bit more about the buying and selling of gold reserves so far this year.
Yeah, look, I mean, central banks have been a real highlight and a real area of focus for everyone who's kind of got an interest or works within the gold market, because it's been such a huge area of demand. As you rightly say, we saw a massive pickup in central bank demand at the tail end of last year in H2, and that strength has really continued into H1 this year. So in Q2 in particular, we saw 103 tons of net purchases from central banks. Now that's a healthy number, although it was down quarter on quarter and year on year. But as I said, if you combine that with the Q1 number, we get 387 tons of net purchases for H1 2023. And that's a record first half in our data series back to 2000. So it really highlights the point I made about the strength in central bank demand still being there, and the continuation of a long-standing trend of central banks buying gold that we've seen since about 2010. But what we're seeing at the moment is very much a mixture of demand from both emerging markets and developed markets. Primarily on the emerging market side, we saw banks like the Bank of China, the National Bank of Poland were big purchasers during the quarter, and they're familiar buyers, but certainly it goes to show that the sentiment towards gold is still very positive. And in fact, we published results of our annual central bank survey in May, which again helped to support our belief that central banks still remain very, very positive towards gold, and that supports the numbers that we've seen. The one big story of the central bank space was Turkey. Now, Central Bank of Turkey has for a number of years now been a pretty significant buyer of gold, but they abruptly flipped to being a net seller in March, and that continued into April and May at pretty large volumes. And the reason for that was very much down to local dynamics following the unfortunate earthquake that occurred in Turkey earlier in the year. They suspended or temporarily banned some of their imports of gold. And then following that, there was a surge in demand. So a supply gap emerged, and the central bank stepped in to help fill that supply gap by selling from their own international reserves. So that was very much an event-driven period of sales from the Central Bank of Turkey, and it acted like a significant drag on the overall Q2 number. But certainly, we didn't believe that was a sustained change from the Central Bank of Turkey, and in fact, they resumed buying in June. Data we've just published in the last week, which hopefully helps to reinforce that despite the selling that we saw from Turkey in particular in Q2, and the slightly lower overall net purchases in Q2, the trend that we've seen in central banks is still very much positive and still very much in place.
And if we look at sort of investment demand, what were some of the most interesting trends you saw during Q2 in regards to gold investment?
It was really a story or a picture of two different components. So investment, the way we measure it is made up of bars and coins. So typically bought by retail investors, so 1 kilogram and less on the one side, and then on the other side you've got gold ETFs. Now, if we start with the gold ETF side, we actually saw outflows of around 21 tons in Q2. Now, while that's obviously showing disinvestment, it is actually an improvement on Q2 in 2022, where we saw 47 tons of outflows. So that's still a kind of a positive story. And then if you combine that with the Q1 inflows that we saw, the outflows we saw in Q1 as well, we actually had a relatively soft start for gold ETFs in 2023. And the reasons for that is we've seen the strong equity performance in markets across the world, which provided competition, obviously, and question marks about the economic outlook for the US, for Europe, for many other economies around the world, and then the performance and the kind of the trajectory of interest rates and the pace of tightening from central banks. That all plays a part. They've held up relatively well. The equity markets and interest rates obviously have been increasing, which may have led to a little less interest in gold ETFs at this moment. But contrast that with bars and coins, and actually they were up fairly strongly, I think about 6%, and that really speaks to the fact that we've seen good interest in bar and coin demand for gold out of particular markets. China is an example of where, again, benefiting from the kind of the removal of those COVID restrictions that I mentioned earlier. So taking those two together, we saw that Q2 gold investment overall was up 20% year on year, again, primarily driven by that growth in the bar and coin market. But I'll also want to make a mention of the OTC investment market as well, the over-the-counter. That was up significantly as well in the quarter, showing that in those areas of investment which are maybe a little harder to measure, we saw strong interest in gold as well. So it plays to a really interesting story about how gold investment is working in this environment that we're seeing.
Yeah, obviously continuing on the investing trail. Obviously, a lot of people that listen to this podcast are involved in the mining industry, and they may not necessarily understand the true value of what gold is and what it represents. So for those that obviously are listening and haven't invested in gold previously, why would they look at investing in gold, whether that's coins, whether that's bars, whether that's ETFs? I just wonder if you could just summarize for those that have never invested in gold before, why they would actually look at doing so.
Yes, of course. I mean, certainly we have what we term our strategic case for gold, and that's what we position gold as an investment, and the reasons why it is such, we believe, an important strategic investment that people can make, and it forms and it helps to form a much more well-diversified portfolio. So some of the points that we raise around that and why we believe gold is such a good investment is, firstly, gold is a highly liquid asset. And by that, I mean, it has an incredibly large market with a large number of participants. And it means that you can transact very, very easily. You can buy very easily, and ordinarily you can sell very easy. And that includes times of market stress. So there have been many instances we've seen historically where some investors may find some of their investments harder to sell in certain market conditions. And if you look at gold during times of market stress, actually it maintains that liquidity, which means you can still transact. I would also make the point that gold is no one's liability. So you own the physical gold, it's kept by yourself. You're not relying on a counterparty. So it links to not having a credit risk, for example. You're not worrying about who that counterparty is, their credit worthiness, for example. That gives you that extra security. And the final point I would make actually is that gold is scarce. Gold is a relatively scarce material, and therefore it is proven over time to actually preserve its value very, very well. And that means, when there are times when portfolio may ebb and flow in terms of value because of your different components, equities, bonds, whatever it might be, over the long term, which is why we deem it, or we believe it's a strategic asset, is because it holds that value. It's certainly something that can benefit, we believe, investors over time, whether that's 10, 20, 30 years, it could be more. The final point I would make overall is certainly gold benefits from a number of sources of demand, as we've gone through briefly now, and it's these attributes, this very diverse demand base, which gives gold its characteristics, allows it to deliver long-term returns, and therefore help improve diversification. And as I mentioned, underpinned by that large market, which gives it that liquidity that is beneficial to many investors.
Your report notes that jewellery demand remains resilient, obviously in the face of pretty high prices. What factors support jewellery demand?
Yeah, absolutely. So we did see jewelry consumption fall year on year by 3% in Q2. But if you contrast that to the persistent high prices that we've seen in most markets across the globe, you can actually see that as quite a resilient performance, which is what we say in the report. And it was relatively flat quarter on quarter. Now, ordinarily, gold jewelry, I should say, is incredibly sensitive to gold prices, understandably, and income. Now, what we're seeing at the moment is we're seeing relatively high gold prices and question marks, uncertainty around economic growth, which therefore has an impact or potential impact on incomes. So when we see that gold was down marginally in the quarter, given some of those conditions, actually that does paint a much more positive picture, at least in relative terms. And if we look at some of the markets that we saw kind of highlights, we can see China was certainly one coming out, as I said, of those zero COVID policies, rebounding. Certainly that was an area of highlight, but we also saw increases in Turkey and Japan. Now, the buying in particular that we saw in Q2 in jewelry was actually surprisingly driven more maybe by an investment motive. Now, there are instances in certain markets, it's quite common to see gold jewelry, which typically tends to be plainer gold jewelry, bought as a quasi-investment. So it's not simply a piece to be worn only, it's actually forms part of your savings. It becomes an investment because of the content of the gold. So what we actually saw is in many markets, because of the uncertainty in the economic picture, question marks around how economic growth will behave, what's happening with interest rates. We did see instances of jewelry demand being driven by that investment motive, because obviously with the prices higher, jewelry demand understandably will be impacted by the affordability and the cost of living crisis and the impact on disposable incomes. So jewelry bought as a luxury good may have been impacted because of those factors, but certainly if you look at gold jewelry typically being bought as maybe as I said, a quasi investment, that certainly we saw positivity on in the most recent quarter.
Obviously, speaking about high gold prices, it averaged just under $2,000 an ounce during Q2, which I believe is a record high also. How did this impact the supply and demand dynamics?
It's a good question. I mean, as I mentioned, gold has a very diverse demand base, and because of that, it will behave differently. We like to call the gold market, or a term we use often is its self-balancing nature. And by this, we mean the different sectors of gold demand will behave differently depending on market conditions, and one of which is the gold price. So in Q2, as an example, we saw, as you say, record high quarterly average gold prices. Now, that had a kind of a pressuring impact on the more fabrication elements, the more consumer-driven elements. So jewelry, for example, or technology, they were impacted by the higher prices in a negative way because of affordability, because incomes were squeezed, people were less able to go out and spend on items such as necklaces or smart devices, whatever might contain gold. And so we did see that come through in the numbers. However, if you look at the gold price, the higher gold price in other contexts, if, say for investment, that's actually a positive. We saw that gold price go up, that trend of increasing gold prices potentially be a positive driver for some investment, where investor thought this signals to them that certainly the environment that we're in, the economic environment is highly uncertain, and so for that, for that reason that they would increase their interest in gold, and through that, buying bars, coins, or ETFs, for example. And similarly for central banks, again, they operate slightly differently, but certainly they're not immune to the gold price. So depending on how that's behaving, it can potentially have a small impact on some of the selling, especially that we see from certain countries which buy from domestic sources. So the impact of the gold price will be varied. It's not necessarily a simple one-to-one relationship. Gold price goes up, gold does well, or gold does badly. If you break it down into those different sectors, you will see that the gold price will have a slightly different impact, and that leads to the more nuanced picture, and why we write the report, to really help explain not just how the whole gold market in aggregate has performed, but how the different components, investment, jewelry, central banks, technology, for example, how they behave and how they sum up to the overall performance of the gold demand.
Before I ask you a little bit about the outlook of gold, the gold industry for the remainder of the year, what challenges do you see the gold mining industry face over, I suppose, the next 6 months and going into next year, whether that is the price, whether that's production, or anything else? What challenges do you see the industry facing?
Oh, it's a good question. I mean, I certainly think, as we mentioned earlier, inflation is still very much a big factor for the mining industry. We already talked about all-in sustaining costs being a record high in Q1. We're waiting to find out what the figure was for Q2, but certainly, as we're seeing for CPI for all of us in our pockets, inflation may come down, but it might do so ever so slowly, which means that not necessarily that inflation is just going to disappear overnight for mining companies either. And so that creates a potential challenge in terms of managing those costs in relation to how the gold price is doing. Certainly on the production side, where we haven't been aware or made aware of any significant challenges. As we mentioned, Q2 was a record high, Q1 was a record high, and certainly it seems like there are relatively few stoppages that are causing a noticeable impact on global mine production at the moment. So certainly, I think it's very much mining companies managing the cost increases that they've been seeing for the last several quarters, which I would imagine are unlikely to kind of dissipate anytime soon.
And lastly, what's the gold outlook for the industry for the remainder of the year? What do you see happening?
Yeah, so I mean, for the full year 2023, our expectation is that investment demand is going to be relatively unchanged compared to 2022. If you look, we've already spoken about relative softness in ETFs and to a lesser extent bar and coin, but offsetting that is stronger OTC investment. So that's going to have a kind of an offsetting effect, which means that we believe that it's going to stay relatively stable. I think at the moment, gold in general is up against a couple of headwinds in terms of the trajectory of interest rates and question marks about where that's going to go. Certainly, how that's going to have a knock-on effect on things like the US dollar. So there is no immediate catalysts that we can see to propel gold performance at the moment, and that reflects in investment demand being relatively flat as we see it at the moment. If you look at jewelry and fabrication for things like technology, again, with the gold price at the level it's at, that may remain relatively subdued. Because again, the affordability angle, not just for consumers but also for fabricators, that is going to have a knock-on effect, and certainly I think we're likely to see that pressure continue on affordability into the second half of the year. Again, inflation not likely to completely disappear anytime soon, and so that's a downside risk for jewelry and technology. One positive that we can definitely be very optimistic about is central banks. As it stands, we foresee that central banks are going to remain net purchases for H2 and overall full year 2023. And again, the reasons why I think we've spoken about previously, but the uncertainty that we've mentioned in the market, the lack of counterparty risk, I think gold is a very natural asset for central banks to own, and certainly the trend that we've seen since 2010 is very much of accumulation, and they continue to do so at a fair clip. So we don't certainly see that changing around abruptly anytime soon. So certainly central banks, we believe, will be positive, a positive for gold demand in the year as a whole. So that's a flavour of some of our demand expectations on the supply side. We've already mentioned about how we feel that mine production is on course potentially for being an annual record. And again, on the recycling side, something we haven't touched upon yet, for the full year, with high prices, that potentially lends its support to higher recycling. We haven't seen a significant pickup just yet, but we maintain a view on that potentially with the higher prices, if they become sustained or increase more, then potentially that might elicit a bit more recycling in the market.
Krishan, really appreciate your time in giving us an update on the gold industry, and obviously your report that you recently released. If our audience wants to view that document, wondered how they can go about doing that. Obviously, you've got the website. Is the Gold Council on other social media platforms as well?
Yeah, absolutely. So we have our website, goldhub.com. You can download our gold demand trends report, and certainly you can see all of our insight and research and data available on there as well. We are on Twitter or X, whatever it's called, at Gold Council. I'm on Twitter, X as well, at Krishan Gopaul, and we post regularly updates on news and the gold market that we think is very relevant. So you can definitely check us out on there. So yeah, those are the main ways in which to stay up to date with all the kind of the content that we put out. And certainly, we hope that it's useful for people in the market.
Yeah, certainly. And we include those in the show notes accompanying this episode as well for easy access. Like I said, really appreciate your time. Thank you for listening, and hope you enjoyed that episode, and appreciate if you can share this, obviously, with people in the industry, but people outside of the industry. Gold can be relevant to everyone in the world, whether it's for investment, people may use it for jewelry. So it gets people outside of the mining industry understanding what relevance gold is in our life. And I think a lot of people don't know that gold is in certain technologies that we use, obviously a minute amount, but it'd be good to, if you can, share this episode with people outside the mining industry, as well as obviously people inside the mining industry. So hope you enjoyed that episode. Lots to take away there. And until next time, happy mining.
Thank you for listening. Remember to reach out to Rob via the show notes, and be sure to subscribe and leave a review. Until next time, happy mining, helping each other to improve the mining industry.